A lot of the people we talk with get worried they won't have enough or that they'll run out of money when they see their portfolios start dropping. You may be having similar feelings that you really need to do something different in the latest market decline because you don't want to go through this again. We know this because we've talked with hundreds and hundreds of families and helped them through rough markets over the last 20 years, like 2000, 2007, and the latest in 2020, by building durable financial and retirement plans that they can have confidence in as they go through that decline. And now we've compiled a lot of the ideas that we've talked with clients about in an ebook. It's got 7 things you can do to prepare your portfolio for market volatility. And you can download that free. We'll have that in the description below. Now, if this is one of your first times watching our videos, I'm Chad Smith, and I'm a partner and advisor at Financial Symmetry in Raleigh, North Carolina. And I'll have my partner, Grayson Blazek, joining us shortly to dive into this week's topic, where we're talking about dealing with tax complications and consequences of dealing with the death of a spouse. Things like, how should my tax filing status be handled this year? How should I deal with the sale of my house and the taxes dealing with that? Also, how will my investments change in the taxes that I'll need to pay on those? So let's dive in. Unfortunately, we've been through this, right, with many clients and helping them walk through this. So we thought it'd be helpful to just walk through some of the occasions and case studies that we've encountered. So do you want to jump in there to that first one and talk about some filing statuses? Because that's generally the first question that comes up.
Right. So we've tried to line this episode up in such a way that kind of walks you through it. A couple of the more direct changes that will be applicable across every client or every taxpayer, really, who deals with the passing of a spouse. And then some tax planning opportunities, things to watch out for, that type of thing. So really, the first most direct change to a taxpayer situation with the passing of a spouse, and the first question that generally comes to mind is, how is this going to impact my tax filing status? So generally, with 2 spouses, you have married filing jointly. It covers just about every married taxpayer. Some people do married filing separately, but for the majority of cases, it's married filing jointly. So in the year of passing, you can continue to file that way. The IRS allows you to file as married filing jointly. So really, in the year of passing, your overall tax situation from a filing perspective is pretty much exactly the same. While married filing jointly is permitted, to keep in mind, it's always, it could make sense to explore married filing separately, but that sort of situational, and it will depend on the taxpayer situation. And when it comes to actually filing the return, software, or if you use tax software, it generally kind of walks through the process. And assuming a personal representative has not been appointed, the surviving spouse can just write file as surviving spouse in the area where the decedent spouse would typically sign, and you're able to file the return that way, and the IRS will process it, understanding that your spouse is obviously unable to sign the return themselves.
So, most cases, of course, we hope people are working with a certified public accountant, or at least an enrolled agent like Grayson, someone that has passed, an exam to process a tax return. But if you are handling it on your own, that's where some of this, you might want to look into and or find a qualified CPA to help you through this process. So what's our next step there? You had a few options.
Yeah. So again, in the year of passing, you can really stick with how you've typically filed. Married filing jointly, potentially married filing separately. So the next step, of course, is into that next tax year. How do you file? And it really comes down to whether or not you have dependent children on your tax return. So there's some qualifications that allow a child to be a dependent on your return. A lot of it's age-based, but if their surviving spouse remains unmarried and claims a dependent child on their return, they can actually file as what's called a qualified widow or qualified widower for the 2 years following the year of passing. And the real advantage or benefit of filing as a qualified widow or widower is, under that tax filing status, their surviving spouse obtains essentially the exact same standard deduction as if they were married filing jointly, and their tax brackets for qualified widow or widower match that of married filing jointly. And in the IRS's mind, really the benefit or reasoning behind this is it essentially gives the surviving spouse a couple of years to transition financially from a tax situation where there were 2 spouses into eventually a single filer, assuming that they don't remarry. So the qualified widow or widower, again, is only available if you have a dependent child that you claim as a dependent on your tax return, but it is going to be an option to kind of bridge the gap for a couple of years, 2 years again, until you're going to be required to begin filing as a single filer unless you get remarried.
And so, how about those people, the surviving spouse with no dependents?
So if you don't have a dependent, the qualified widow or widower is not going to be an option. And so that tax year following the year of death, again, assuming you don't get remarried, you're dumped into the single filer bucket, as you would have been if you, or you would be if you're not married. And so in that case, that carries on in perpetuity until remarriage occurred, if it did occur. And so that can come with some somewhat disadvantageous tax burden. So a lot of it comes down to income levels. Marginal brackets are lower for single filers. Again, that standard deduction is halved from a married filing jointly standard deduction. But on the flip side, understand that it does reduce the standard deduction. It can actually come with some tax planning opportunities potentially. A lot of this depends on the client's or the taxpayer situation, but are they back into itemized territory for deductions? Do they have mortgage interest? Do they have charitable giving levels that puts them above that lower standard deduction? And if they do, it's a potential opportunity from a tax planning perspective to benefit from the itemized deductions again.
Yeah. So that, right. So,
yeah, so really, in summary, it comes down to that those years after the year of death, it is in the first 2 years, it's situational. Depends on if you have a dependent on your tax return or not. And then after that 2-year window, you're going to be looking at a single filer.
Yeah. So, after you get through those first steps, right, and you're into that filing status, moving down the return a little bit, we start to get into the nitty gritty and the details about the actual accounts, right, and some planning opportunities that are there to take advantage of. So, and I hate, saying opportunities in a situation like this sounds trite, but you're trying to look for things that can help you, right, as a result of what was going on there, because you might have owned assets jointly with your spouse. So what does that look like, Grayson, in that circumstance at that point?
Yeah, so it's called a step up in basis. So as a taxpayer, when you pass away, any taxable assets you have generally are going to have what's called a step up in basis. So that's takes the value of whatever you purchased at and increases it or pegs it to whatever the fair market value is on your date of death. And so when you're incorporating a spouse into that situation, it starts to depend on the type of state you live in. So there's community property states and there's non-community property states. We operate in North Carolina predominantly. Of course, we work with clients across the country, but for today's purposes, let's just kind of look at a North Carolina example. Being that North Carolina is a non-community property state, property that's owned jointly, so between you and your spouse, receives a 1/2 step up in basis. So that's where things can get a little bit tricky. And it really is, it's really highlights the importance of following up, making sure you're keeping good records. And once the death does occur, is just following up with the custodian or wherever those assets are held to make sure they actually do increase the basis to the correct new value. So I find this is probably easiest to sort of explain as a little bit of an example, keeping in mind that this is just a general illustration, likely oversimplified, but I think it'll help understanding a little bit. So let's say you and your spouse purchased numerous mutual funds and ETFs in a joint brokerage account over the years. So over the past decade, let's say the two of you have been regularly purchasing mutual funds and ETFs in a brokerage account. So the basis, which again is what you all have purchased these funds for, is $100,000, and the current value of the account is $500,000. So in the IRS, or in the eyes of the IRS, your half, understand that you own half of this, is worth $250,000. So just half of $500,000, and your basis is $50,000. So half of that $100,000. The same goes for your spouse. So let's assume that your spouse does pass away. So at passing, your half, your basis, and your value are going to remain the same. So it'll still be 50,000 basis, 250,000 fair market value, but you receive a step up in basis for your spouse's half. So this increases their basis from 50,000 to the fair market value on the date of their death up to 250,000. So as such, the basis of the account goes from 100,000 prior to passing up to 300,000 on the date of death or after passing. So it sort of consolidates the capital gain exposure, but you have to have an understanding that there is still some exposure there, somewhat unique in a spousal relationship where if you were just a beneficiary of, say, your parents' account, it would operate a little bit differently and you'd get a full step up in basis. So all that being said, this is really why it's really important to follow up with the custodian that holds these assets or work with an advisor on the account to assure the step up in basis is appropriately incorporated. And as this can result in material tax savings when you actually eventually go to sell the assets in the future.
Yeah, a step you don't want to miss there, because it could be significant savings and or tax due if you do miss it. And so on the other side of things, some people may have capital loss carryovers, right? Some capital losses that were a result of a big investment that went wrong from years past that they haven't been able to use up all of those losses through the year. So how does that work in this circumstance of the death of a spouse?
Yeah, so it could be an investment that didn't quite go right, or it could be a result of tax loss harvesting, which is something we look to do during market downturns as sort of an opportunity. So these capital losses that are harvested can be used to offset capital gains over time and up to $3,000 of ordinary income each year on your tax return. And these carry forward into the future if they're not fully soaked up in the current tax year, and you can use them in subsequent tax years when you go to file your return. Unless, and this is sort of the caveat here, is what happens to these when your spouse does pass away. And the IRS states that capital loss carryovers are only deductible by the taxpayer who sustained or realized the loss. And this is where understanding how accounts are registered becomes really important. So say an account is owned solely by the decedent spouse. If the capital loss carryover is attributable to the account owned solely by the spouse who passed, any carryover loss, and this could be a couple $100s, or this could be thousands and thousands of capital loss carryover that is not absorbed in the year of death, is lost. So it just falls off. And that really highlights a potential planning opportunity is in that year of death, if there is capital loss attributable or capital loss carryover attributable to the decedent spouse, does that present an opportunity to harvest some capital gains and soak up all of that capital loss that, if not used, is going to sort of disappear in a situation like that?
Yeah, one you'll want to take advantage of if you can, right? I mean, before you face that, if you have any kind of understanding of what is to come, with an illness of some sort, then something to think through. So, of course, a lot of changes tend to happen once a spouse passes, and you're thinking about potentially downsizing, right? And you might be looking at selling a home in that circumstance to do so. So, what's the impact if you're going through that, and you want to make sure you're not missing anything on that tax side of things?
Yeah, so the IRS allows qualified taxpayers to benefit from what is referred to as a primary home sale exclusion. So to qualify in general, you must have lived in the home as your primary residence for the greater of 2 years and have not used the home sale exclusion in that 2-year period. So if qualified, individuals or single taxpayers can exclude up to 250,000 of gain on their home sale, primary home sale, and married filing joint filers can exclude $500,000 in capital gain when selling their primary residence. So as you can imagine, that's potentially some pretty material tax savings if you qualify. And it's these numbers start to get fairly large, but in recent years, or really the past few years, depending on how long you've lived in the home, and given recent material increases in property values, it's certainly possible you may find yourself toward the top end of that range, whether it be a time, you've just lived there for 30 years, or you live in an area that's really exploded from a real estate perspective. So if your spouse passes away, it begs the question is, if I'm a single filer now, can I only exclude $250,000 of gain on the home sale? So contracting that from 500 down to 250. It's a natural question because all of a sudden, you're just one individual taxpayer. So the passing of a spouse, as it's certainly a transitionary period and often comes with a need or potentially a want to sell your primary residence. This could be to downsize, move closer to family or friends or a support system that is needed now. And so, regardless of the reason you choose to move from your primary residence, fortunately, the IRS provides a grace period of sorts in the event of a passing of a spouse. So, if you sell your home within 2 years of the date of death, you you own the home jointly with the decedent spouse prior to their passing, you will remain eligible for that full 500,000 capital gain exclusion on the sale, but it must happen within 2 years of the date of death. So not 2 calendar years, but 2 years from the date of passing. So it's certainly important to keep that date in mind if you find yourself thinking about potentially moving, or you could see yourself moving in the future. Just understand that if you look to sell your home after that 2 year window, you're going to be down to that 250,000 of capital gain exclusion.
Yes. So one of those circumstances that we think through as we're building out tax plans, right? Because we do that for wealth management clients we work with each year to try to understand how the income is being taxed coming in from different sources. So that's something that you might want to think through a bit in this next question that we have here, these other circumstances, because as Grayson mentioned, you're dealing with the filing status change to begin with. But what are some of the other avenues and questions that people have around income at that point and how that may change?
Yeah, these are more just somewhat clerical in a sense, but with so many life changes that come with losing a spouse, it's easy to forget about things as simple as adjusting withholding. Let's say you work and you have earned income, W-2, with a lower standard deduction and your income possibly being taxed at a higher rate just because marginal rates are more or are lower for single filers. It's important to update your employer or inform your employer of the passing. And generally that comes with filing a new W-4. Generally, when you first filled that out, you probably selected married filing jointly. So you want to update that to a single filer. They're going to withhold a little bit more tax from each paycheck. And so when you go to file your return in a future year, it's going to close the potential withholding shortfall that could occur if they continue to have withholding based on married filing jointly. It's not a fun surprise come tax time to owe a bunch of money in tax. So it's certainly easier to have that withheld through payroll. And that can be as simple as just filing a new W-4 with your employer.
Yep. And then on the retirement account perspective, of course, we've had some legislation changes over the last few years, right? On the Secure Act and how some beneficiaries are scheduled to take out distributions. But if you're the surviving spouse, how does that look and how should you think through that, the framework of setting up a withdrawal strategy?
Yeah, and that's very true. As a surviving spouse will need to decide how to handle retirement accounts that they inherit from their spouse. Uh, as Chad mentioned, it's changed a lot in recent years, and to me, this topic really requires special care, as there are a number of options. A lot of it depends on your age and the age of your spouse when they passed away, to really get a better understanding of the options that are going to be available to you and the option that may be most advantageous from a tax perspective. So maybe that's a topic I can hop on for a future podcast.
Yeah. Yes. Many hours of analysis are spent to try to find the best circumstances to help you through these situations. And, we try to end each episode with progress principle, the idea of just taking one small thing here, right? That you can implement. And in this circumstance, it's really reaching out to a financial advisor or an accountant, right? A CPA to help you through some of these things, because many times you want to take this off of your plate when you're dealing with it. And you don't have the time or the energy when you're going through, an emotional event that's likely one of the biggest ones that you'll have to tackle and kind of move forward past. And it's a difficult time. So if you haven't reached out to an advisor, you're going through this now, or someone that's going through this now, I would encourage you could reach out to us on our website at financialsymmetry.com through the Talk to an Advisor button on the homepage, or you can reach out and find an advisor near you at napfa.org. in a PFA, and just someone to be a second opinion, listening board, just to help you through a really tough time in most circumstances. Grayson, anything else you'd add there?
No, absolutely. I mean, I completely agree with all that. It can always help to have, sort of an ally, somebody to help you through situations like this. In some cases, it's taking as much off of your plate as we can. And really just making sure that no surprises add additional grief to an already very difficult situation.
Yeah. Yeah. I mean, that's what the job of a fiduciary advisor entails, right? Putting your interest first and trying to be there for you and help you through things to make things easier and to make sure you're not missing potential opportunities in the midst of, an emotional roller coaster. So hope this is helpful. A little more specific today, but we've been through it a couple of times, had many conversations through the years, and thought it might be helpful to have a resource out there for people that aren't working with an advisor, so they can, have a pathway to find some help. So thanks for joining us. As always, we have 160-ish episodes of our podcast. You can check out many other videos, over 100 videos on our YouTube channel too, that with other helpful topics that may be of interest to you. We put these out every 2 weeks. Really appreciate you listening. Appreciate all your feedback and questions, and keep them coming. We're happy to answer other questions that you have, and we'll walk through examples for you. Talk to you in 2 weeks.